This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, welcome everyone to tonight's Q&A open house. I'm AJ Monty, Chief Market Strategist with the Market Guys, and it is right at the top of the hour. And today is the 24th, so we still have some very long days, with Friday being the equinox, the longest day of the year as far as light is concerned. And I'm really excited about what happened in the market today, and not everyone would share that emotion or feeling with me. But the reason I'm excited is because for a while, it looked like the markets were going to get out of control. And I mentioned this on the weekly market report that, the markets rallied even in the face of, us having to potentially take military action against Iran. And that story is still unfolding. And the Fed is talking lower interest rates, and that stimulated the market. And now we're, coming into the G20 economic summit. We don't know what's going to happen with China or negotiations with China and the U.S.-Chinese trade war. But let me say this, because this is really important. I am still longer-term bearish on the market. And you have to think about some of the things outside of the technical analysis realm, what we're looking at here. Imagine for a moment that, all of a sudden, U.S. and Chinese have a truce and things are looking really good. Most likely, we will have a knee-jerk reaction to the upside, all right? It'll probably be a pretty big move, too. So we have to be careful of that. And then what? Then what do we have after that? I mean, now we have to wait until, election season and campaigning and the mudslinging and going back and forth. And it's going to be, in my opinion, I think it's going to be a volatile roller coaster for maybe the next year or more. I don't know. Hence the reason why I'm leaning so far into the technical signals, because for all of us, it's very easy to get caught up in opinions, right? We all have opinions, and many times we take positions according to those opinions. And for the longest time, I've told people, keep your opinions out of it, because that could get you in trouble. Focus on the charts. And even when we focus on the charts, we're not 100% right, nor have I ever claimed to be that accurate. But what I did notice as I was starting to scan the charts in preview for this webinar, I went back and I started looking at some of the other lines that I drew in the past. You can see back here, these were forecast lines that I never erased. And last week, if you remember, I did erase that line. Let me zoom in so I could show you. I got to go the other way, zoom in. All right. Last week, which was Monday, Tuesday, Wednesday, Thursday, Friday here, I said that we would most likely pull back to the 20-period moving average. Why? Because there's gaps below the market here. The volume was dropping here. The stochastics at the time were overbought. The CCI, as you can see back here, was crossing with a sell signal, right? So all those signals are pointing lower, and I drew a downward forecast. Well, guess what happened? It didn't go down. It went up. But what I also noticed in going back and looking at my previous forecasts over time is that what I'm doing as far as timing is something that I don't believe any other analyst is doing. Most of the analysts that you see on the financial programs are going out there and talking longer term trends and what they think the markets are going to do. But each and every week, I'm going on a day-to-day forecast. And many times, I'm giving two-legged forecasts. And what I mean by that is I'll say something like, okay, the markets are going to go down, and then they hit here, and then it's going to bounce and go up. And for anyone to do that, it's extremely difficult. Now, I'm not trying to give myself excuses for being wrong, because I'm totally admitting I'm wrong a lot of the times with the timing. But when I went back and I looked at the targets, eventually what's happened is the targets have been hit in a wide majority of the time. So when you're trying to analyze your own stocks and looking at the charts, try not to look so much at the timing, but look at the price, the end price target, and understand that I'm a big follower of, gap fill points and, price reversals from the gap fill points and all that. And what we have to do, most importantly, is say to ourselves, okay, well, this is what I think the stock is going to do. But as a tool for forecasting, the charts double as a tool for managing risk. So let's say right here, let's say we progress throughout the rest of this week and we continue lower, like I said we would most likely do. And then here at this point, we see, okay, a possible bounce. So let's say at this point right here where my cursor is, we have a bounce. And we say, okay, gap is filled. There's the gap support level. I'm going to buy it. So you buy it, right? Again, based on the technical signal and the 80-20 rule for gap fill and reversal points. Well, this line that we drew in a horizontal way here now becomes the most important line on the chart. Yes, we all want to make money when it bounces and we want it to go up and all that good stuff. But this horizontal line is the most important line on the chart, because if you take a long position and it doesn't bounce, or it doesn't hold the 20-period moving average, or it doesn't hold this gap fill point, or it doesn't hold this low down here as a support level, what are you going to do? Are you just going to hold on and continue to lose money? December and May were the two toughest months of the 12-month calendar period, the previous 12 months. Those are the two toughest months. I did take a hit in December. I took a hit in May. But I do expect that over time, like I have in the past, how many years now? 32 years. I haven't lost money at the end of any year in 32 years. So, yeah, that sounds like I'm bragging, but I'm not. I'm just telling you that as position traders, whether you're an equity trader or you're an option trader, accept the fact that you're not going to be right all of the time. Accept the fact that you will be taking losses over time. But in the end, your goal, as long as you stay steadfast to your risk management disciplines and don't let things get out of control, your goal is to, at the end of that year, make money and continue to make money year after year after year. And that also includes making money on the downside. So with that said, don't type in any stock symbols yet, because I'm going to go through the analysis. I'm not even going to look at the Q&A box right now because it clogs up my charts. In fact, let me try to move this over and give you a little bit more chart room there as I fill the screen. Okay, so this is obviously the Spiders SPY, the SP 500 ETF. My forecast for last week, again, this is Monday, this was Friday. My forecast was that we would pull back to fill this gap and then possibly bounce. Now today, again, this is why I'm excited. Today, what happened? If this is actually close to a bearish engulfing pattern. If this was a green body candle back here, that would be a bearish engulfing pattern. But we see a lower high and a lower low today. That is a full pivot point. Let me zoom in just a little bit more because there's a couple things you need to know with regard to definitions in candles. Look here, this doji, following the doji on the 14th, we come to the 17th, which is Monday. We have a higher low, higher high. There's a pivot point. Here we have a higher low, higher high. Here we have a higher low, slightly higher high. Here we have a higher low, higher high. Here we have a higher low, lower high. This candle right here is called a half signal. A half signal is the beginning stages of a pivot point. Now you don't always get a half signal when a market is shifting the momentum, but it's important to know what a half signal is. It's when you have higher highs followed by higher lows, and then you have a higher low on this day with a lower high. It's a shift. And now when you combine this lower high with the fact that we have a long shadow or even inverted hammer, that is bearish. And when you see that on lower volume, that too is bearish. You see? So why am I telling you this? Well, because we've now got a full pivot point here to the downside. So the next time you see any kind of a half signal, the good thing to do is if you're long any stock or if you're seeing that signal on an individual stock, the good thing to do is to raise your stop to a level just below the low on the half signal. Now, if you had done that on an individual stock, again, I'm just using a scenario here saying this is, ABC stock, and you put your stop below that low, guess what would have happened today? That's right, you would have been stopped out. Now, we'll have to see how this goes, but, backing up just a little bit, notice what's happening with the oscillators. Stochastics crossed last week. I mentioned that on the weekly market report. Today is a full sell signal on stochastics. Today, I got to zoom back in again. Sorry for going back and forth and making you dizzy like that. But look at the CCI. That CCI is now crossed down below the 100. So today we have the sell signal on the CCI. So be careful if you're long any S&P stocks because we are pulling back from this. I would call this a major resistance point right here. All right. Now, keep in mind, this is like last week, what were the financial news outlets talking? Oh, we hit a record high in the S&P, and now, volume goes up. On Thursday, people are buying the stock, and wow, they're reacting to this positive. We got a new high in the S&P. And all the people that bought on Thursday are going, uh-oh, on Friday. And today they're stressed. Now, understand how that plays into the equation, the psychology of what's going on. If you have any short-term traders that took a long position on Thursday and then held on Friday to see this happening today on Monday, there's a good chance those people could start getting out to limit their loss and just accept the short-term loss and wait. Now, I'm talking about the smarter, more experienced traders who initially thought they were going to get a breakout here because this close over the high back here on higher volume for a lot of the, we call them swing traders / momentum traders. They were expecting a breakout there, and on Friday they didn't get the follow through. You see, so this is turning pretty negative, and we might hold that gap fill point. We might not. We might go all the way back down and eventually hit my target from last week, which is the 20 period moving average. Again, we'll have to wait and see. Now, I'm going to hop to a more broad-based index, which is the Russell 2000, because this is very interesting because a couple things happened today. This is a very significant red candle. And remember, this is 2,000 stocks that are being tracked in this index, not like the 500 of the S&P. Now, this is a long red shadow, but there is no long red body, but there is no shadow at the bottom. What that means is that the market closed on the low and we didn't run out of sellers, we ran out of time. Chances are tomorrow morning, this selling is going to continue, right? Now, the other thing, stochastics crossed last week. It's now starting to pick up some momentum on the downside. But here's another interesting thing. Last Friday, when I recorded the weekly market report to be put out Saturday morning at 6 a.m. Eastern, thanks to Kenny, I forecasted that the CCI would drop. And so we are almost at my price target here, and it's only Monday. So I'll have to see how that pans out. Now, as I go to the Qs, which is the NASDAQ, / tech sector, Stochastics now has the sell signal today. The CCI is a hair sliver away from a sell signal there. The volume is dropped, and we have a lower high, lower low with gaps below the market. So the odds now, even though the odds were pretty high when I forecasted last week that we would go lower, the odds are increasing now that we'll go lower. So if you're sitting on a position, you think, I'm going to give it a couple more days, you might want to rethink that strategy about giving it a couple more days, okay? That's the cues. And then finally the diamonds, and then we're going to get into your stocks. This is an interesting candle pattern today because we have a half signal here today, right? Unlike the S&P and the Russell 2000 where we had a full pivot, today is a half signal for the diamonds. Again, starting here, higher high, higher low, higher high, higher low, higher high, higher low, lower high, higher low, half signal. On lower volume, on much, much lower volume. This is about 40% of the volume from last Friday. Stochastics are crossing with a sell signal, and the CCI, it looks most likely that that's going to cross tomorrow with a sell signal, right, with gaps below the market. So this is what we're faced with. Be careful. Again, be very, very careful that you don't get trapped in the hype of the news. Be very careful you're not taking positions based on your opinion. Be extremely mindful of your risk management strategies, and be sure to stay completely focused on the charts as you move forward and look at individual stocks. Now, the option traders, folks, you could start typing in stock symbols now, and then I'll make some comments as you're doing that because I know there's a slight delay in that. The option traders are in actually a better position than equity traders, because when you are a spread trader, you're somewhat hedged and can maneuver even when a spread goes against you, more so than equity trader. An equity trader buys a stock. If the stock goes against them, the only thing they could do is sell at a loss or sell at a profit. There's two choices. That's it. If you hold on and you're undecided, not really a good strategy. The only two real choices are, do I buy or do I sell? And so the option trade is a good position. If any of you are trading equities and would like to learn about options, email me, AJ@themarketguys, and I'll give you some resources. One quick plug. I have been working very diligently to put together a 20-class course that's pieced together with market shot classes. There are 15-minute classes, and we're trying out a new venue that's similar to iTunes, where I'm going to be posting the 20-class course on this venue. I don't have the name just yet because our other partner, Bill, is working on that. But I spent many weeks putting this together, and it's going to be available for $14.99 on this online venue. So that's going to be something that's going to be, I know you're going to like that. It's a technical analysis course, and I'm already working on an option course that's going to start off beginner, go to intermediate, and wind up with advanced. That too will also be 20 classes in the 3-part course. So stay tuned. We got a lot going on at the market, guys, and I think you're going to be happy. Okay, so Phil is Wynn Resorts, Wynn Resorts, WYNN. Again, folks, if you can, please let me know what your intentions are. Like Phil has, no position, want to buy for the $4 dividend and some appreciation. All right, now, just so you know, Philip, if you buy a stock and they offer or pay out a dividend, you do know the stock is going to drop in the amount of the dividend, don't you? I mean, it's nice to get that cash, but chances are the stock will drop by that amount. So, again, this is where option traders do really well. If you're going to buy a stock for the dividend, you buy the stock, sell an out-of-the-money call, which allows you to collect money. And if the stock drops, you're going to make money on the call, and you get paid the dividend. So that's a great way. It's called a covered call. It's a very simple strategy, And it doesn't take much to put that one on. So again, for those who are, Philip, I don't know if you're an option trader, but you might want to consider that as an additional part of your strategy to collect a $4 dividend. So right now, it does look like when resorts are over the 20-period moving average, but look at the stochastics and look at the CCI. They're giving sell signals. So while you're busy collecting the $4 dividend, this stock could wind up dropping $7. Long dramatic pause there to make sure that sinks in, right? You're going to get paid $4, but you could potentially lose $7 on the appreciation or the share price. So be really, really careful. If I were looking to do that, I would be buying the stock at 122, selling the 115 calls, taking a big chunk of money. If the stock drops, I keep the dividend, I buy my calls back at a profit, and then I unwind the whole position with a big happy smile on my face. That's how I would do it. But I think the stock could initially pull back before bouncing. But I do think it's going to bounce, and here's why. History tends to repeat itself. Look at what happens when, in the past, when the stock has broken out over the 20-period moving average and 20-period moving average has started to move up. Here, you could see it went from 110 to 130. Here, again, it went from 108 all the way up to 140. Here, it broke out over the 20-period moving average, went from 123 or 124 to 150. So it could pull back, but then eventually go up. But again, if you're going to get long this stock, I would most certainly put my stop below the 20-period moving average. Again, because if you look what happens when the stock breaks out below the moving average, it also continues lower. So that's my spin on that one, and hopefully that works out for you. All right. So Mike is saying, I think everybody waits to see what happens at G20 with the Trump Z meeting, and that could very well be the case, Mike. But there's also an old saying that goes, "Buy the rumor, sell the news." So the rumor could be they're approaching an agreement. Okay, just like all the other times, Trump tweets, things are looking good, and the market, and $2 trillion comes into the market. Listen, I'm a supporter of Donald Trump, but I don't agree with what he does with the tweets. I really don't. I think there's too much at stake. The average person is being affected by this in their 401k. I think the tweets should be calmed down, especially anything that could affect the markets. And Elon Musk is a perfect example of why we shouldn't tweet things out. So Tesla is having a hard time, and we'll see what happens. They're having a night launch soon, and it's going to be a dramatic one, and stock might rally. Or if one of the boosters comes down in someone's house, it's not going to rally. I mean, there's some big risks here that you have to consider. So buy the rumor, sell the news. Yeah, you could buy the rumor that things are going to happen, and there's going to be a treaty, a peace, agreement, trade agreement. And then when it actually happens, what's going to happen? People are going to sell the news. That's what I think is going to happen, is you'll get the initial rally, and boom, they're going to sell into it, take their profits, and move on. Okay. Eric, hey, welcome. Hope things are going well for you up there in Canada. Let's see, your thoughts on BA. I'm long the January 340 calls. Well, I'm going to tell you right now, because I have a position in this one, Eric. If you're long the 340 calls, I would be selling the 375 calls against it, maybe the 380s, and turn that into a diagonal spread. Because if you look, and forget, and for the equity trades, just bear with me as I talk some option language here with Eric. If you look at the July, why is that was a long transition there. All right, if you look at the July 375s, that is a lot of premium. That's $9, Eric. If you go up and sell the 380s, you're still collecting over $7 a share on that one. So I think that would be a great benefit for you if you own the calls, and it's okay to have the 340 calls because they're in the money. So part one, and I know you know this, Part one is to sell to collect the premium. Part two, what I would do in the Januaries, bear with me here, folks, I would roll up your January 340 to the 350. Are you along the January 2020s, I imagine, right? I'm guessing that that's the case. If you long the 340s, I would sell the 340s to take your profits, to sell those for $50 and buy the 350s in their place. You can even do the 360s. If you buy the 360s, you're still in a long position, but you're taking in $13 of profit by rolling up on that long side. So you're taking the $13 in profit by rolling up. You're taking $7 if you sell the 380s, and you are a happy camper because you're taking in $2,000 immediately upon doing that for every single spread. If you have five spreads, that's a big whopping 10 grand that you're putting in your pocket. So that's what I think you should do, and I think that would be a good one for you to do as well. Okay, John. Hey, welcome, John. Active trader du jour, trades the stock of the day, and John is looking at GLOB. He's carefully watching that as he puts in the notes there, and he's looking for an entry position. Now, GLOB, John's one of our mentor students. So, John, I would be very careful with GLOB, and I would probably continue watching it. Watch it carefully. I would not be entering it, at least in the near term, because this is very, very close to a bearish engulfing pattern today. If it had opened any higher, that would have been a pretty significant long green red candle. The stochastics today is crossed with the sell signal, and the CCI is crossed with the sell signal. Look at this gap down here. Be careful. Again, that is around 94. So there is a good chance this stock could drop to fill that gap. Now, normally I would say, wait for the gap to fill and buy it. But you have to watch that 20-period moving average, because in order for this stock to go down to fill that gap, it's going to have to break out below that 20-period moving average. And that's a game changer, because that could be a shift in the momentum. So you got to keep a close eye on that one. If all of a sudden the stock drops and then all of a sudden bounces off that 20-period moving average, I would be a very, very tentative long position, take a very, very light with a very, very tight stop below that 20-period moving average, and that's how I would treat that one. Okay, Mike, yes, you're right. Who knew one tweet can move billions of dollars? But that's the world we live in. It's such an amazing world of technology where, it's a double-edged sword, really, because, if it weren't for the internet, if it wasn't for smartphones, and I was talking to John Wiseman about this, I would have to sit in front of my computer all day long and watch the markets. But if I put a spread trade on and I put my price alerts, or I put my limit orders in to get my trades done, and I know exactly the moment my trade is executed, because my broker emails me the alert, then I have that freedom. I'm breaking the chain, and I'm not tied to that computer. Even day traders, I would have to say, have limited their freedom because they're still tied to the computer. Again, the beauty of swing trading or swing trading or option trading using the charts the way we do is that you can turn your computer off and walk away. And there's a couple things that happens when you're able to walk away. Number one, stress lowers, right? Actually, there's a few things. Stress lowers. You could sleep better. You got more freedom. And I like that. I like freedom. It's a great thing. And so I'm not going to harp too much. I'm not on a campaign to, convert the day traders to swing traders, but it's something to consider. All right, Fran is long RIOT, and now Fran is long at 256. Now, Fran, this is a good thing for you, what I'm about to say, and it follows right along with the gap fill rules that I talk about all the time. 80% of the time, a gap will fill. 80% of the time after it fills, it reverses. Well, guess what's happening for you right now? It's reversing. It's broken out over the 20-period moving average, and it's done so on high volume. Let me zoom in here so you can see how great that volume is for Fran. Now, the bad news. Ready, Fran? The bad news is there's a gap. It gapped up today. So now that it's gapped up, there's an 80% chance that the gap will fill. So you're in a little bit of a tough spot because you have a long shadow above that candle. The stock actually could go back down there to fill the gap at 276, which still keeps you 20 cents, in the money on that trade. But then you're going to have to sit there and wait for the stock to bounce to feel really good again. And I think it could. So I don't know how many shares you have, but if it's up tomorrow, okay, you might want to consider selling half the position. And this puts you in a win-win situation here. If you sell half the position tomorrow because it's up, and there's an 80% chance it could drop back down to fill the gap and then bounce, then you have locked your profit on at least half the position, while at the same time created more buying power for yourself to be able to participate on a pullback and bounce. So in other words, if you sell half the position and then it drops, guess what? You get to buy more shares with the other money that you just freed up. So that's a good thing for you. And congratulations. I think that's a good trade. Fran, while we have you on, what day did you actually buy those at 256? Did you buy yesterday Friday or Thursday? I'd like to know what the candle looked like when you did buy it. I know there's a little bit of a delay there. I'll wait for Fran to see, and then we'll wait 2 more seconds. It's a long delay, I know, but anyway, 3 days ago. Okay, so 1, 2, 3 here. All right, so on the 20th, you had a little bit of a hammer pattern. On this one, yeah, you had a stale red light. Yeah, I would have gone along with that buy 3 days ago. Absolutely, because you had a long stretch of red candles known as a stale red light. You had a drop in volume here, and you had a little bit of a hammer pattern there, so that's good. Okay, so hopefully I helped you out. And let's go right to Jim, who is asking me to look at VNQ. And is this a Canadian stock? Jim, my system here, this is I think a swim. It does not give the Canadian stocks. I'm so sorry. I'm going to have to pass on that one unless you have another symbol, and I'll go right to you if I see it pop up. Okay, go to active trader, Jeff Summer in good old Florida over here. Where is it? Let's see, where is it? I know I just had the symbol there on Tesla. All right, let me get that. Oh, I see. What's going on here? I'm not on my screen. I got to clear that out. TSLA. And let's see. Jeff is saying he's long Tesla at 200 and the 65 puts. Okay, so you own Tesla at 200 and you own the 165 puts. Well, I don't know if the puts are going to do you any good right now as the momentum is starting to shift up. So, but the good news for you is that they're probably not worth that much. And being long the stock at 200, you're already $23 in the money. Again, like I said before in my comments about this spectacular launch that everyone's anticipating, living in Florida, it's pretty amazing because we could see the rocket boosters from Central Florida, and it is dramatic. And if it's a clear night, you could literally see these rockets enter space and leave the atmosphere. It's very, very dramatic. But with the new technology that Tesla is using, with the boosters that actually return to earth. There's been some instances where they didn't recover all over time, but I think that it could actually work out because they have been pretty successful with their launches, and it's giving them positive press. So technically, the momentum is shifting higher, and on Friday, you were very, very close to a bullish engulfing pattern. If it had closed any higher, that would have been a very well-pronounced bullish engulfing pattern. The thing that you have to watch at this point is the volume. See how today the stock is higher high, higher low. That's a full pivot point, right? But the volume is low. And so if you get a candle that's weak or is showing a candle on weaker volume, then Jeff, I would, if you own the stock at 200, I think I might be misunderstanding you. I'm thinking, because it says you own Tesla 200 and 165 puts. I think I may have misread that in thinking that now you own the 200 puts and the 165 puts. If that's the case, I would close those out because I think it could go higher. All right. But if you're long the stock and you see any kind of a weakness, then I would start selling calls against that. Okay. So hopefully that helped you out. All right. Let's go right to Gloria. Welcome. In bold type, Gloria puts out, may I have your opinion about keys.n? Time to sell, question mark. Okay, now hopefully Keys is it Keysight Technologies? There it is. Okay, is it time to sell? I would say no, but it is time to put in a trailing stop. And Gloria, are you in Canada? If you could answer that while I make my comments about this stock. It is looking very positive, especially on the 20-period moving average, because this stock, it has a very nice cycle. And what I'm going to do is I'm going to shift this to a weekly chart so you can see the kind of cycle that I'm talking about. This is an upward trend. And what I'm going to do is give everyone a lesson. Kim, I'm coming to you next. Don't worry. Okay, you're in Vancouver, Gloria? Okay, welcome. All right, so what I'm going to give everyone a lesson on, particularly Gloria, because this is her stock, is a lesson on how to draw fan lines. This is a weekly chart, so I'm going to the most extreme low all the way to the bottom, and I'm going to try to connect as many of these lows as I can early on and then project out. You see how I'm doing that? So notice, 1, 2, 3, 4 points I connect to draw the trend line. Then what happens is, notice how the high pivot point here is a higher high. So the way you draw a fan line is you go to the last point that touches the first trend line. Now I'm recording this, so if you need to review this, just hit the rewind button when you listen to the recording. All right. So I go to the last touch on the previous trend line, and I use that as my new starting point for the accelerated trend line. See? And I project out. Now I could do it this way, or I could do it this way, or I could split those two. So there we go. Now what do? I go to the last line on that trend line, the last touch, and I project out to right there, the next low. Then I just keep doing this until I can't do it any longer. Now, normally, Gloria, what happens is the stock most stocks form 3 accelerated fan lines. Rarely do you see 4. Hardly do you see 5. Now notice on the weekly chart, this is almost vertical. Now, remember what I said, is it time to sell? Not yet, because it's not giving you the sell signal, but it is definitely time to trail the stop, right? So you could, if you notice, isn't this interesting? I didn't know this until I switched to the day chart. This most accelerated number 5 fan line is matching up almost perfectly to that 20-period moving average. So what I would do is I would pick an area right below this accelerated fan line, and that would be my get out point. All right. So that's how you do it. And keep in mind that there's also an open gap all the way down here, right around 72, 73. All right. So be very careful. This is another one of those stocks that, you can't really go wrong selling half the position, right? Can't go wrong selling half because the half that you sell is locked in profit, right? And the other half is something that you have to protect, and then you can play it along the way. Okay, here we go. Time for Kim, another mentor student. Kim is looking at GDX. Comment there on GDX is been buying and selling this on the way up. Still room to move higher? Question mark. I would say yes, but be very careful. This is, again, just what I talked about with Gloria. You have a stock that's going almost vertical. If I go back to the weekly chart, I could do the same thing, but I'm just going to do it a little faster. Boom. There's my first line. There's my second line. Second fan line, almost vertical. Remember I say most stocks have 3 fan lines, right? So I could even do this. There's my third, right? So, there we go. So you have a stale green light after a bullish engulfing pattern last week. You have accelerated volume. But here's the thing, Kim, and you know very well what I'm going to say here with regard to volume. You get a stale green light with a gap below the market and increasing volume. What are you going to look at in volume? I'm asking Kim this specifically. What are you going to be watching for? In fact, we could have everyone else chime in. If I were to see a drop in volume while stock is moving up so aggressively, what is that telling us about the buyers? Well, Kim was first to answer because I targeted her on that question. She's looking for a decrease in volume because if there is a decrease in volume, it means the buyers are getting tired. And let's face it, there's a lot of people that bought this at the end of May for around 21. It's now trading 26, and they're scratching their heads asking the same question. Is there still room to, go up? And, there's a lot of people that don't want to give up such an amazing profit on that one. You see, that's almost 25% return on that. They don't want to let that one slip through their fingers. So they're going to be very protective. And most people who know how to draw fan lines are going to be putting their stops right below. So, Kim, as I zoom in, I would say put your stop, if you're still holding on this, put your stop right below today's low and don't look back. If you have not taken a new position, then I'll wait for the gap to fill here and keep an eye on that 20-period moving average. All right? So that's helping Kim out right there. And then let me go. Hold on, I lost my place and we still have 18 minutes, so keep your stock symbols coming in. We're really doing well. All right, so all right, Fran answered me with regard to her stock when we were talking about RIOT. Fran is looking to add to the position. Be very careful, Fran. I like your idea of adding or buying on strength, but when a stock starts to get exhausted, you have to play that a little bit differently. All right. So Mike is SPWH trading the channel. Okay, Mike, are you in the position, or what channel are you talking about? Because there's a couple of different channels. There's a down channel now, and there's a sideways channel on the weekly chart. The sideways channel here is, I'm going to clear all these lines here. The sideways channel is really taken from this low back here. And if I project out, you'll see it matches with the most recent low a few weeks ago. The upper channel line resistance is up here. So if this is what you're using, Mike, then it's more advantageous. I would say the probability is that you're going to be making more from a long position than shorting it, number one. Number two, I hate shorting anything below $5 because for the U.S. investors, I'm not quite sure how the margin is handled in Canada, but when a stock is down below $5, the brokers require more cash to be put up as a margin requirement because it's considered a riskier stock. Now, with that said, the the margin requirement changes when it goes over 5. So if you play this, let's say you buy it at 372 and it bumps its head up against 5 and pulls back down, you're absolutely taking a profit. If it goes up, crosses over 5, closes over 5, you buy more at 501. And that's because now all the people who have SPWH on the books have now freed up quite a bit of margin dollars, and a lot of times they continue to buy into it over 5. A lot of people don't know that. If you notice, all the other times that the stock crossed over 5, what happened? It rallied right here, 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 boom. It rallied right up and went up to 6.5. So I still think you'd play it from the long side if you haven't already. Going back to the daily chart, you just have to keep an eye on this because, short term, you got a little bit of a bearish engulfing pattern there, but the big test is going to be tomorrow to see whether or not it holds over that 20-period moving average because it closed right on it. Okay, so that's going to be something you have to keep an eye on. All right, Dylan is thinking about selling a credit put spread in Netflix. It's NFLX. Now, Dylan, before I get into the technicals of this, let's talk about the story of the stock. All right, we got Google, AOL, Netflix, right? We got the internet stocks, Amazon, and we are looking at a company here that I think is going to change the future of internet technology and entertainment simultaneously. Now, this is interesting because, as I mentioned at the beginning of this webinar, I am being affected by Verizon streaming data plan, right? I have a very big plan, but most of what I do online involves video production. Right? I do market reports. I do trade alerts that involve video. I post video. I need to have streaming video. My charts are streaming when they're ticking right away. And so if companies like Verizon and what's the other one, Viasat, if they don't get ahead of the curve with regard to technology, if they continue to put caps on their data plans, they're gonna be pushed to the wayside. Those internet providers are going to be in big trouble because Netflix is the driving force. It's the gorilla in the room that is pushing other companies to change their technology. I also know that cable television, whether you have Roadrunner or whoever, they are, this is a great example. They're losing customers like crazy because television programming has shifted. Roku is taking over a huge market. They're competing with Netflix. YouTube TV is the new wave, an up-and-coming preferred method for entertainment for people. When the markets are not, I'll give you an example. When the markets are not open, in other words, when that bell rings and I'm done with my work, guess where you can find me? I'm out of my greenhouse. I'm growing and farming and hunting and fishing. That's what I do. I love doing that in Cedar Key. And I developed a new YouTube channel to show people how to build a greenhouse, how to grow vegetables. I have two channels. I have one for the Market Guys channel, shows people how to make money trading stocks. I have another one that shows people how to grow food. And that's the wave of the future. And I'm reaching a lot more people than I ever expected because people click the like button, they click the share button. So again, getting back to Netflix, I know it's a long intro into what I think the stock is going to do, but it's very hard to short Netflix. What I would do is keep a very close eye on this one, and this is one of those stocks that you play from the long side. So what Dylan is talking about with regard to selling a put spread is a bullish strategy. So here we go. Channel line number 1 on the weekly chart. Fan line number 2 There's fan line number 2. What did I say? Most have 3 fan lines. Take the last touch on the second fan line, project up. There's fan line 3. So here's what happens, Dylan. I don't know what your strike prices are, but this is going to help you quite a bit. Take careful notes on this. Here's the rule for fan lines. Whenever the last fan line in the sequence, 1, 2, 3, so this being 3, whenever the last or most recent fan line is broken, generally there is an 80% chance that the price will move and drop to the next fan line in the sequence. So again, here's fan line number 1, fan line number 2, fan line number 3. If it breaks below fan 3, it'll most likely drop to fan line number 2, which is right around what price? That's around 376. Now that second fan line will most likely act as support. So if you're selling a put spread, you want your strike prices to be below that fan line. You want it to be roughly, you want your strike price to be below 375. Oh, I'm so sorry. It's the wrong price. You want that to be below 402. Wait, what's going on? Look at my lines there. Hold on. The box is giving me bad data. Oh, okay, because it's reading the trend line. Here, this is the one that has to read. Yeah. All right, so it ends at 351. So your strike prices need to be roughly below 350. And that's going to put the odds in your favor. Sorry for the confusion. I was reading the wrong data on that data chart. Okay, so that's it. But overall, I think Netflix could pull back, but ultimately I think it's going to bounce, and I think they're going to do just fine over time. Even in the down market, Netflix is one that could wind up actually holding its own as more or less a defensive stock. Okay, Hi is asking for, can you please look at TPR? We're down to 9 minutes. We still have plenty of time right here. TPR is Tapestry Inc. Here's a stock, relatively inexpensive when you compare, stocks on that scale of, what to trade, what not to trade. This is priced within a good area for most investors. This one has been in a long-term downtrend, so I'm going to have to look at the weekly chart to really get a better picture on this one. And it looks like the stock is bouncing off of a 3-year low. I have to even go back to the monthly chart to see if there's any support whatsoever. Yeah, there is. Okay, so this low right here is the next support level. So it is see, this low right here, because this is a monthly chart, this is back in late 2015. So it's not going to show up on the daily chart. But now that I drew it, now I can go back to the daily chart to see exactly where I'll be putting my stop. So if you are buying the stock, the key support level to keep your eye on is going to be this from the monthly chart. So right around 26.5 is where you're going to be putting your stop. All right. So right now it looks bullish because it's breaking out over the 20-period moving average. Momentum is still going up, but you really have to keep an eye on the stochastics because that is defined as being overbought. What I would do on this one, if you bought it any lower, again, I don't know what price you bought it. Okay, your long TPR on 620. All right, so you bought it on 620. Let's see what that is. All right, so you bought it, even if you bought it at the high, you bought it at $30.90. If I were you, I'd take a profit, right? I would take a profit. That's almost a 3% return in just a couple of days. I would take a profit and then wait for it to pull back because the stochastics look like it could really turn back down. And you don't want to turn a loser into a winner. So again, you could take a profit on the whole thing. You could sell half the position, protect the rest. You could sell calls against it if you're into options. If they have calls, I think they do. And you can move on from there. All right, so when would you sell? I think I answered that question. I just saw the follow-up question on there. Again, if it was my position and I was up in just a couple of days, I'd sell half at least, and I'd put my stop below today's low. That's what I would do. All right. All right. So, all right, Gloria, you said you're in Vancouver. I'm scrolling through as quickly as I can. Do I see? All right, Phil is looking at waste management. All right, still have a couple more stock symbols to get through. We're doing the rapid fire stock analysis. Hope you're enjoying it. I'm almost running out of breath. Let's see. Waste management doesn't have a position, but thinking about accumulating it. All right, this is another one of those stocks, Philip, where, you know, I'm expecting the Dow to pull back, right? Now, does that mean that waste management is going to pull back with the Dow? No, but we do often see the domino effect. If the Dow pulls back, then you get that sympathy sell-off even in the good stocks that are beating earnings expectations, right? So if I were you, again, I would wait for the market to look more bullish, and then I would look to see whether or not this stock fills the gap down here. You know, this is, again, either the gap is going to fill, but before the gap fills, it'll bounce off of the 20-period moving average. So the support level is right around 112, almost 113. So there is a good chance it could pull back to the 20-period moving average and bounce. So this would be your best entry point, because if you look back in the past, the stock does have a tendency to bounce off of that 20-period moving average. You see, here were perfect examples. So I would wait for it to pull back to the 20-period moving average, wait for a good strong signal, bullish signal on the bounce or pivot point, put my stop below the 20-period moving average, and then that's the done deal, right? So that's good. All right. So Fran, again, is looking at GBTC, long at 1140. Sell it. Yep, I'd be all over that sell button. Fran, I would absolutely be selling the heck out of this right now, because that is a classic, what they call evening star. It is one of the most reliable sell signals. You had one back here. Here's the difference. This is very much an inverted hammer. An evening star is when it gaps up with an inverted hammer or a doji. You see? This is an extreme sell signal. In fact, I wish you would have got this question to me like 5 minutes before the close of the market today, because chances are it's going to open up lower tomorrow. It's still okay. If you take a profit, there's an old saying, you can't lose money taking profit. Bitcoin is out of control, and it's it's up there, what, around 10,000 last I looked. I have the New York, I have the Bitcoin index that I keep on my chart here, and a lot of this is thanks to Facebook. You're probably following the news. Where's my index? Here it is. And yes, it's almost 11,000. This one doesn't track on a daily chart, so you have to look at the weekly chart. Now, back here, all right, now keep your ears open, Fran. Back here, I forecasted Bitcoin would drop in a dramatic way because this bearish engulfing pattern, and there were gaps below the market. Since Bitcoin has been around, it has filled all gaps except for this one here and this one here. So what does that mean? It means there's an open gap up here at around 14,000. So you're caught between a rock and a hard place. There is an open gap here now on the weekly chart, and there is an open gap here. So what does that mean? Again, this is a weekly chart. Going back to your stock with the GBTC, right, you have to weigh this all into the equation, because this one is showing, again, that very powerful sell signal. So if you want to trade this one, there's nothing wrong with that, because it's a cheap way to do it. You could sell your position to take the profit, wait for it to pull back a little bit. I'm going to use this real quickly, and then I'll probably wind up I got to get to Eric's Starbucks. So I'm going to go 2 minutes over. But Fran, you might want to learn how to do the Fibonacci retracements. Okay. Fibonacci retracement is, where is it? I know it's percent. Here it is. Here it is, right here. What you do is you measure from the low pivot point to the most recent high, and it's going to give you the pullback points. Right, so as I zoom in here, you'll see that most of the time when you have an extreme move, stocks pull back to the 50% retracement level, which would mean 1227 as a reasonable or expected target price in the short term. So if this one pulls back, not only will it fill the gap, but it could very well pull back to the 50% mark. And look at that. The 50% mark is right at a resistance point, so that'll be a roll reversal support from that resistance. And if you didn't understand what I just said, then go to the Market Guys website and look at the roll reversal video that I have on there for our members and for the general public. So last but not least, I'm going to wrap up with Starbucks for Eric. And Eric is, let me see what your comments are there. It scrolled away. I'm thinking about bearish strategy, but interested in your comments. Well, for the longest time, it was very hard for me to short Starbucks because I love coffee. And I'm thinking, well, I'm not the only one that loves coffee. But Starbucks is and has been in a significant upward trend. So you got to be careful about taking a bearish strategy in a stock that's just been like a freight train in the upward direction. So here's what I'm going to do for you. Here's fan line number 1, right? Now, what am I going to do? I'm going to switch to the daily chart and start building off of that fan line. So last one in that sequence gets drawn out to here. Remember I said most are showing 3, few are showing 4, and rarely do we show 5. So what you have to do, Eric, is you got to set a price alert for when it drops below this fan line, because if it does, and I think it will, stochastics are pointing lower and the CCI giving a sell signal, then there's a chance, a good chance, that it will drop to the next fan line in the sequence. So that would mean the fan line is going to end, that right there is right around $78. So if you sell, let's say sell a credit call spread, go way out of the money, because if it doesn't pull back, well, the only other alternative is it's going to go higher. So you got to go way out of the money on that one and be very protective. But I would initiate it on any closing price below that fan line. So draw your own fan line there so you get that data point on your own chart, and then set up a price alert to notify you when that happens. So we, as usual, didn't run out of stock symbols. We just ran out of time, and we certainly didn't run out of fun either. I have a lot of fun doing this. This is actually my favorite time of the month. I've said that many times, and that's because I get to connect with each and every one of you. This is a great time. The only thing I ask, it's a simple favor. There's a lot of people that are more or less in the dark about technical analysis and risk management. I'd like to ask that you please share this information. Share the weekly market reports with people. Share the open house Q&A recordings. If you're a member, share them with people. Go to the Market Guys page, like the page. Go to the YouTube videos, like those, share those, subscribe to those. And I can tell you that I'm not ever, Eric knows this, John knows this, we got Kim knows this, all my mentor students know this. I am never, ever going to retire from this. Retirement is not something that I think of as sitting on the couch and watching football games. I am always going to be in teaching mode. I just love it. I think it's a great way to spend your life, is to pass things forward for people and provide value. And again, the only thing that I'm asking is that you help me build that audience of people who could use the help. And I give you my commitment and my word that I will absolutely do my best to do that for them. And I'll never embarrass you. So with that said, I'm going to wish you all a very good night. I'll look forward to speaking with you on the weekly market report next Friday. And we'll talk to you then. Take care. Bye-bye.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.